imagine for a second that you could actually buy the sun. Well, not the whole burning ball of gas, obviously that might be a bit hot to handle, but a specific revenue-generating slice of its energy.
Right.
Imagine owning 1.54 gigawatts of solar power without ever having to climb a ladder or install a single panel on your roof or worry about whether a pigeon just ruined your investment. That's kind of the poetic promise of the financial instrument we are looking at today.
It is a compelling image, I will give you that. But you know how I look at these things. I am allergic to poetry when it comes to a portfolio. In the world of finance, specifically within the Indian infrastructure space, that promise has a very boring, very bureaucratic name.
The Sustainable Energy Infra Trust.
Exactly. SEIT for short. And my job today is to take your poetic image of buying the sun, and we'll run it through a forensic audit until it confesses its actual cash flow potential.
Which is exactly why we are doing this deep dive. For you listening right now, we aren't just reading off a marketing brochure. We have a stack of source documents that, frankly, is giving my desk a bit of a structural integrity problem.
It's a lot of reading.
It is. We have got the annual report from FY25. We have the outcome of the board meeting that just wrapped up in February 2026, some very dense excerpts from the Red Herring Prospectus, or the RHP, and some detailed stock screener valuation models and sustainability reports. Our mission today is a complete teardown. We are stripping away the ESG fluff to answer one single question. Is SEIT a viable income generator for your portfolio, or is it a value trap?
And we need to be very precise right up front about who that investor is. Because if you are tuning into this looking for a multi-bagger stock that's going to double in 3 months because of any new narrative, you should probably turn this off right now.
Yeah, wrong room.
You are in the wrong room entirely. This is not a casino.
Fair warning given. So who is allowed to stay?
The serious income investor, the kind of person who treats their capital with respect. We are looking at this through the lens of a senior allocator. We are absolutely obsessed with 3 things today. Distributable cash flow, or DCF, yield sustainability, and risk-adjusted returns. We aren't betting on a horse. Here we are evaluating the fundamental economics of the racetrack itself.
I really like that framing, buying the track. So let's start with the absolute basics, because this isn't a normal stock ticker that you just buy and hold hoping the price goes up. It's an InvIT. Can you explain the vehicle before we try to drive it?
Sure. So an infrastructure investment trust, or an InvIT, is essentially a mutual fund for physical assets. Instead of buying shares in a software company or a bank, the trust buys the actual physical infrastructure. That could be toll roads, it could be power transmission lines, or in this specific case, solar parks. But the key difference from a regular publicly traded company is the mandate. A traditional company can choose to hoard its cash. It can decide to build a massive new headquarters or buy corporate jets. An InvIT is legally obligated by SEBI regulations to distribute a minimum of 90% of its net distributable cash flows back to the unit holders.
Let me make sure I've got that. So it's a pass-through vehicle, basically. It collects rent, or in this case, electricity bills. It pays the basic maintenance. It pays the interest on its debt. And whatever is left over absolutely must go to me, the investor.
Precisely. It turns concrete and glass and silicon into a quarterly paycheck.
Okay, the structure makes sense. Now let's talk about the pedigree. In real estate and infrastructure, you really don't want to buy a bridge from a guy who usually sells used cars, right? Yeah. So who are the parents of SEIT who put this together?
The pedigree here is actually the very first pillar of the investment thesis. You have 2 sponsors, and they are quite a fascinating pairing. First, you have Mahindra Susten.
The Mahindra Group. I mean, they are ubiquitous in India.
Yes, a major subsidiary of Mahindra & Mahindra. They are one of the leading renewable energy players in the country. What they bring to the table is the local execution, the engineering, the boots-on-the-ground reality of running these plants in Indian conditions. They know how to acquire land in Rajasthan. They know how to deal with local regulatory bodies and labor.
Okay, so that's the operational muscle. But who is providing the money?
The money, and honestly, more importantly, the governance backbone, is the Ontario Teachers' Pension Plan, or OTPP.
The Canadian teachers, I feel like I see their name attached to everything from international airports to water utilities.
You do, because they are an absolute global heavyweight. As of the data we have, they manage about 249.8 billion Canadian dollars in net assets. They invest in over 50 countries worldwide, but do not just gloss over the pension plan part of their name.
Why not? I mean, capital is capital, right?
Not at all. Capital comes with different ticking clocks. Pension capital is what we call patient capital. They operate on 20, 30, even 40-year time horizons. Unlike a private equity fund that desperately wants to pump up the valuation and flip the asset to someone else in 5 years, OTPP needs this asset to generate steady, reliable cash for a retired school teacher in Toronto in the year 2040.
I see.
That aligns perfectly with a retail income investor's goals. Because they are playing the long game, they demand absolute global standards of governance reporting and risk management.
So it's basically a marriage between Indian operational grit and Canadian institutional governance standards.
That is the pitch, yes. It tells you right away that this isn't a fly-by-night operation. It is completely institutional grade.
Okay, so the parents are rich and responsible. Let's talk about the kid. What does SEIT actually own? You mentioned 1.54 gigawatts earlier.
Yes, that is the total operational solar capacity. It is spread out across 8 operational sites. A very significant portion of this capacity is located in Rajasthan, specifically tied to the Rewa Ultra Mega Solar Park and a few others in that region.
Now, here's where I usually get a little skeptical with infrastructure. You can build the most efficient, beautiful solar park in the world, but if your customer decides not to pay the bill, you just have a very expensive glass art installation in the middle of the desert. Who is actually buying this power?
This is the counterparty risk question, and I'm glad you brought it up because it is the single most important line item in the risk assessment of any power project. You are absolutely right to be skeptical. In India, the state Discoms, the distribution companies, are notoriously slow payers.
Right. I have read horror stories in the business papers about state boards delaying payments by 12 or 18 months.
Exactly. It can bankrupt a smaller operator. However, SEIT has hedged this exposure incredibly well. Approximately 96% of their entire capacity is tied to power purchase agreements or PPAs that are backed by central government entities or very financially strong state players.
Let's be specific for the listener. Who exactly are we billing every month?
The primary off-taker is SECI, the Solar Energy Corporation of India. This is a central government nodal agency. It even has its own payment security fund. We're also billing DMRC,
The Delhi Metro Rail Corporation.
the Delhi Metro, and MPPMCL in Madhya Pradesh. Now, just think about that for a second. The risk of the Delhi Metro defaulting on its electricity bill is fundamentally different from a struggling rural state electricity board defaulting.
Yeah, because if the Delhi Metro stops running, the entire capital city literally grinds to a halt.
Exactly. It's mission-critical infrastructure. This specific customer mix provides a thick layer of sovereign or quasi-sovereign security to the cash flows. The money is good.
Okay, so the check is highly likely to clear. Let's talk about the size of the check. That's why people tune in. We are looking for the cash machine. We have the data from the board meeting outcome on February 4th, 2026. This is incredibly fresh data. What is the payout looking like?
It is looking robust, but let's parse the numbers carefully so we don't mislead anyone. The declared distribution per unit, or DPU, for the first 9 months of FY26, so that is April 2025 through December 2025, is 8.26 rupees per unit.
Okay. 8.26 rupees for 9 months. I know the listener sitting there with a mental calculator. How do we annualize that properly?
Well, you cannot just divide by 9 and multiply by 12 blindly.
Why not?
Because seasonality exists in solar. Solar generation is naturally lower during the monsoon season due to cloud cover and a bit lower in the winter due to shorter days. But for a rough workable estimate, we're looking at roughly 2.75 rupees per quarter on average. So for the full year of FY26, my estimate puts the annualized payout in the range of 11.0 to 11.3 rupees per unit.
Okay. Let's anchor our math on an even 11 rupees to keep it simple. Now, context is everything. The FY25 source material mentions a unit price hovering around 108 rupees. Let's look at the yield relative to that specific price.
If you manage to enter at that 108 to 110 rupee mark, an 11 rupee payout gives you a pre-tax yield of roughly 10% to 10.2%.
A 10% yield. Now, I am going to play devil's advocate here because I have to. I can go out today and get, let's say, 7.1% on a completely risk-free Government of India bond, or maybe a fixed deposit at 7.5%. Is a 2.5% to 3% spread really enough to justify taking on equity risk? Because let's be honest, I could lose my principal here if the trust goes sideways.
That is the correct challenge. It is the exact question every senior investor asks. You're taking on equity risk, an operational risk, a weather risk for a 300 basis point spread. Is it worth it? To answer that, you have to look under the hood at the leverage. How exactly is that 10% being generated? Are they borrowing recklessly to pay you that yield?
Let's open the balance sheet then. What are we looking at?
The total debt sitting on the books is 32,442 million rupees, about 3,244 crores. The leverage ratio, which is calculated as net debt divided by total asset value, is sitting at 45.12%.
45% leverage. Isn't that high?
For a traditional manufacturing company, yes, it would be a bit elevated. For an InvIT, not at all. It's actually a very comfortable sweet spot. The regulatory cap allowed by SEBI is 70%, provided you maintain a AAA rating and have a proven track record of distributions. SEIT currently has the AAA stable rating from CRISIL, so they are operating at roughly 45% leverage against a hard 70% ceiling.
So they aren't maxed out on their credit cards, so to speak. They have plenty of room to breathe.
Massive room. But here's a magic number. Here is where the real business model lives. What is their cost of debt?
I am guessing it has to be significantly lower than the yield they generate, or the math completely breaks down.
Correct. Their weighted average cost of debt is 7.37%.
Okay, let's pause here and make sure the listener really grasps this, because it's the core of the engine. They borrow money from banks or the bond market at 7.4%. They take that borrowed money and use it to buy or build solar panels that generate effectively, let's say, a 10% or 11% return on the invested capital.
And the difference between those two numbers, the spread goes directly into the unit holder's pocket as DPU. That is the fundamental arbitrage of an InvIT. As long as their cost of debt stays significantly below the operational asset yield, the leverage works beautifully in your favor. It amplifies your return. But if that cost of debt starts creeping up to 9% or higher, the model gets squeezed very quickly.
Which we will absolutely tear into in the risk section. But first, I want to challenge the growth narrative. When I look at an InvIT like this, I see a bond proxy. I buy it, I get my 11 rupees a year, and that is it. In fact, it's arguably worse than a bond because physical solar panels degrade. They literally produce less power every single year. So why should I ever expect my payout to grow? If inflation is running at 5% and my payout stays completely flat, I'm mathematically getting poorer every year.
That is what we call the melting ice cube theory of infrastructure. It assumes assets just decay until they are worthless. But SEIT is not a melting ice cube. It has what we call embedded growth levers.
Prove it to me. How does the revenue go up if the sun doesn't shine any brighter and the panels are slowly degrading?
Two ways: organic and inorganic growth. Let's look at the actual contracts, the organic side first. There is a very common misconception that all solar PPAs are just flat-locked in tariffs for 25 years.
Wait, they aren't flat.
Not all of them, no. Look at the Reba project inside their portfolio. The source material details a starting tariff of 2.979 rupees per kilowatt hour. But crucially, it has a built-in contractual escalation. It goes up by 5 paisa every single year from the second year all the way to the 16th year.
5 paisa? I mean, come on, that sounds like a rounding error.
It sounds incredibly small on a per-unit basis, sure. But when you apply that to millions upon millions of units of electricity generated, it compounds significantly. It acts as a revenue floor. Then look at the NSPL and Borkipil projects. They have a tariff of 5.99 rupees per kilowatt hour with a massive 3% escalation every year until the 10th year.
Okay, 3% is undeniably significant. That basically matches a good chunk of baseline inflation right there.
Exactly. So even if the management team goes to sleep and they do not add a single new panel to the park, the gross revenue from these specific assets drifts upward naturally over time. And because their biggest cost, which is the debt interest, is relatively fixed or managed, that extra incremental revenue flows almost straight down to the bottom line NDCF.
Okay, that makes sense for the organic side. What about the inorganic side? You said they can buy new assets, but from what I understand, buying mega infrastructure assets is hard. You have to bid against competitors, you have to win the auction, you have to integrate it.
Not necessarily. This is where the ROFO comes into play, the right of first offer.
Can you break that down for someone who hasn't worked in corporate M&A?
Think of it like this. Imagine your brother is a commercial real estate developer. He goes out and buys the muddy land. He fights with the municipal corporation for 2 years to get the environmental permits. He deals with the unreliable contractors. He physically builds the apartment complex. It is messy, risky, stressful work. You do not want to do any of that.
Definitely not. I just want to collect the rent checks every month.
Exactly. So once the building is fully finished, the paint is dry, and the tenants are moved in and paying steady rent. Your brother calls you first. He says, I am ready to sell this completed building. Do you want to buy it before I list it on the open market? You get the very first look at a completely de-risked, fully cash-generating asset. That is the ROFO agreement that SEIT currently has with its sponsor, Mahindra Susten.
So Mahindra takes on all the painful construction and regulatory risk. SEIT just swoops in and buys the stabilized cash flow.
Correct. And the logic behind doing this is that it has to be accretive.
There is that finance word again, accretive.
It is the golden rule of InvITs.
Hmm.
If SEIT is currently trading at an implied yield of, say, 9%, and they could use their 7.4% debt to buy a brand new completed asset from Mahindra that yields 11%, the weighted average yield of the entire SEIT portfolio automatically goes up, therefore the DPU goes up. If they were to buy a bad asset yielding 8%, the DPU would go down. The management's primary job is to ensure they only ever acquire accretive assets.
And there's one more lever you highlighted in your notes before we started, financial engineering. Honestly, that term always sounds like something that got a lot of bankers arrested back in 2008.
In this context, it is entirely legal and just represents smart, active treasury management. We noticed digging through the sources that they're actively replacing their traditional bank term loans with NCDs or non-convertible debentures.
Why bother doing that? Debt is debt, right? You owe the money either way.
Not exactly. NCDs issued in the capital markets often carry lower interest rates than standard bank term loans, especially for a AAA-rated entity like SEIT. Also, if you notice the mix in their filings, 46% of their current debt is fixed rate, 54% is floating rate. This active management swapping a term loan for an NCD just to save, say, 20 basis points truly matters.
Does 20 basis points really move the needle? I mean, that's just 0.2%.
Let's do the napkin math together. On a total debt pile of roughly 3,200 crores, saving 0.2% is roughly 6.4 crores in cash a year. That might sound like a rounding error for a massive global corporation, but remember, this is a pure pass-through vehicle. That 6.4 crores in interest savings flows directly and completely to the distributable cash flow, divided by the total number of outstanding units. That is literal free money in your pocket just because the CFO made a few smartphone calls to refinance. That is the hidden leverage of highly efficient treasury management.
Okay, I'm really starting to see the growth picture now. It is definitely not stagnant. But now I want to get to the absolute meat of this deep dive, the valuation. This is the part where we really need to slow down and look at the numbers.
The ROI question, expected returns.
Yes. Let's set up the scenario. Let's say I am looking at my brokerage app right now. I see SEIT trading at a current market price of 125 rupees. The listener sitting in their car or at the gym wants to know, is that a good deal? Am I fundamentally overpaid at 125?
To answer that with any real authority, we have to build a discounted cash flow or DCF model based on the screener analysis provided. And we are going to walk through this step by step so the listener can clearly follow the logic.
All right, let's do it. Step 1. What are our baseline assumptions?
The base year is FY26. We established the expected DPU for this year at roughly 11.0 rupees.
Step 2, the growth rate. How fast is that 11 rupees growing?
The source valuation model assumes a flat 3% annual growth in DPU.
Hold on a second. You just spent 10 minutes telling me about 5 PESA contractual escalations and 3% PPA kickers and highly accretive ROFO acquisitions. Is 3% really a fair assumption?
It is what I would call conservative to moderate. It bakes in some of the predictable efficiency gains and those known PPA escalations, but it intentionally does not assume they are going to double the size of the portfolio with massive acquisitions tomorrow. It's a very safe defensive baseline for a model.
Fair enough. And step 3, the time horizon. How long are we running this math?
We project these cash flows until the year FY45. That is roughly when the majority of the current power purchase agreements actually expire. That is exactly 19 years from now.
Okay, walk us through the actual cash flow experience. I buy 1 unit today. What happens over time?
In year 1, you receive your 11 rupees. In year 2, with our modeled 3% growth, you receive 11.33 rupees. In year 3, you receive 11.67 rupees.
Okay, fast forward a bit. Let's look further out.
By year 10, which would be FY35, that annual payout has slowly compounded to roughly 14.3 rupees per unit per year.
That is a pretty decent jump from the 11 rupees we started with.
It is. And if you follow that exact same 3% growth line all the way to the very end of the model in FY45, the final year, the distribution is going to be roughly 19.2 rupees per unit.
So visually, the cash flow stream looks like a steady staircase slowly going up year after year. But now comes the technically hard part, the discounting. Because an inflation-eaten rupee in the year 2045 is obviously not was a rupee today.
Correct. We have to discount all of those future distant cash flows back to today's present value to see what they are actually worth right now. The source model uses a strict 10% discount rate to do this.
Let's clarify that. Why exactly 10%? Why not 8% or 12%?
The 10% represents what we call the cost of equity, or the investor's expected return threshold. It is basically the model saying, I demand to earn exactly 10% on my invested money every year. What is the maximum price I should pay today for this specific 19-year stream of cash flows to mathematically achieve exactly that 10% return?
And what is the answer the model spits out?
When you sum up the present value of all 19 years of those projected distributions discounted at 10%, the final number is approximately 115 rupees per unit.
115 rupees.
Yes.
But the market price in our hypothetical app scenario is 125 rupees.
Correct.
So if the intrinsic fair value to get my 10% return is only 115 rupees and the market is asking me to pay 125 rupees, I am overpaying.
You are definitely paying a premium to the base model.
What does paying that premium actually do to my return profile?
It drags your return down.
Yeah.
It is pure gravity. If you pay 125 rupees for a cash stream only worth 115, your mathematical expected return, your CAGR, will be strictly lower than 10%. Based on the cash flows, it will likely settle somewhere in the 8.5% to 8.8% range.
Ouch. So buying 125 rupees essentially means I'm accepting a sub 9% return for taking on equity market risk. That feels really thin to me.
It is thin, very thin. Unless
there's always an unless in finance.
Unless the broader market knows or believes something that our conservative model doesn't.
Yeah.
Why would an institutional buyer knowingly pay 125 rupees today? There are really only two logical reasons. Reason one, they fundamentally believe the DPU growth will be much higher than our base 3%. If they model out aggressive accretive acquisitions and think growth will actually be 5% annualized, the fair value immediately jumps to around 135 rupees. In that scenario, 125 is actually a bargain.
Okay, so paying 125 is essentially placing a direct bet on aggressive future growth.
Or reason two, which is the macro play. Interest rates. If you deeply believe that the central bank, the RBI, is going to slash interest rates significantly in the near future, say bringing the 10-year government bond yield all the way down to 6%, then suddenly an 8.5% return from SEIT looks incredibly attractive relative to the risk-free rate.
Yeah.
Buying at a 125 is essentially placing a macro bet that interest rates are heading down and taking asset prices up with them.
So to summarize, 115 rupees is the conservative fair value for a demanding investor wanting a 10% return. 125 rupees is a bull market price that is actively pricing in either future growth optimism or falling interest rates.
Precisely. If you're a conservative income investor who absolutely demands a 10% margin of safety, you sit on your hands and you wait for a market dip. If you're a macro bull who thinks rates are crashing tomorrow, you might easily justify paying 125.
That is incredibly clear. Now let's stop looking at the sunny upside. I want to talk about what fundamentally breaks this financial model. We have painted a really nice picture of steady 3% compounding growth, but things go wrong in infrastructure, things blow up. What keeps you up at night regarding SEIT?
The very first one is hiding right there in the debt profile we were praising earlier.
Yeah.
Interest rate risk.
Wait, we just said they have a fantastic low cost of debt at 7.37%.
Today. They have it today. But remember that detail I mentioned? 54% of their total debt is floating rate debt.
So it resets based on the broader market.
It resets. If macro inflation suddenly spikes due to a commodity shock and the RBI is forced to hike rates by, say, 200 basis points, the interest expense on that entire 54% chunk of debt shoots up almost immediately.
Let's play that mechanical chain reaction out. If their interest expense goes up, what happens to my dividend check?
Interest payments are senior. They're paid before distributions, so higher interest expense directly equals lower net distributable cash flow. Lower NDCF directly equals a lower DPU for you. And historically, usually when central bank rates rise aggressively, yield-generating stock prices fall. So as an investor, you get hit with a lower dividend payment and simultaneous capital erosion on your principal. It is a nasty double whammy.
Okay, that is a serious macro risk. What is risk number 2?
Operational and technical risk. Specifically what I call the CapEx bomb.
What? The CapEx bomb?
Yes. If you dig deep into the technical assumptions of the source material, there's a specific line item that almost every retail investor completely misses. It explicitly mentions budgeting for a 100% replacement of the plant inverters between years 26 and 35 of the project life.
Wait, 100% replacement? I always thought solar plants were incredibly low maintenance. You just build, wipe the dust off the glass occasionally and collect the money.
The glass panels themselves are low maintenance, yes. They degrade, but they rarely just snap. The inverters, however, the massive electronic boxes that convert the raw DC power from the panels into grid-usable AC power, are not simple. They're highly complex high-voltage power electronics sitting in the blistering Rajasthan heat. They burn out. They absolutely do not last 25 or 30 years.
How much money are we actually talking about here?
Let's quantify massive. If utility-scale inverter replacement costs roughly 50 to 20 lakhs per megawatt, and that is a fairly standard rough industry estimate, and SEIT has a portfolio of 5,540 megawatts, we're talking about a future capital expenditure liability potentially in the range of 300 crores hitting the books.
300 crores just for replacement parts.
Yes. Now, the critical analytical question is this. Is the trust actively reserving enough cash right now, today, to pay for that massive bill tomorrow? Or are they artificially distributing every single rupee they earn today just to make their current 10% yield look really good to the market?
Because if they aren't saving a portion of that cash right now,
then in 2035, when all those inverters start dying out in the desert, they will be forced to either raise very expensive new debt, assuming anyone will even lend to them for maintenance capex, or they will have to slash the investor dividend entirely to zero for a few years just to pay for the new hardware.
so as an investor, we need to be checking the reserves and surplus line item in every quarterly report, looking specifically for an inverter replacement reserve.
We absolutely do. And investors need to watch that balance like a hawk.
Hmm.
If they are structurally under-reserving, the current 10% yield you think you are getting is completely artificial. It is not true income. It is basically a return of your own capital disguised as a yield.
That is a terrifying but crucial detail. Okay, risk number 3. We talked about the government paying the bills and how safe that was. Receivable risk.
Yes, the LPS or late payment surcharge scheme. You see this pop up in their financial books. It usually looks like a line item called other income.
Explain how that works.
When a state off-taker like Madhya Pradesh delays their power payment past the due date, they are contractually obligated under the PPA to pay a penalty, a late payment surcharge. SEIT legally books this surcharge as income. It artificially boosts the reported top-line revenue for the quarter.
That sounds like a good thing, though, right? They are getting extra penalty money.
In a perfect world, yes. But often this is entirely paper money. You recognize the income on your accounting P&L statement, so your earnings look great, but the actual hard cash hasn't hit the trust's bank account yet. You cannot pay real cash dividends to unit holders with paper accounting income. You need actual liquidity.
So they might be reporting a massive quarterly profit that heavily includes penalty fees they haven't actually collected from the state yet.
That is the exact risk. If their receivables days, the days sales outstanding metric starts creaking up from a healthy 60 days to 90 days, and then to 120 days, it creates a severe internal liquidity crunch. They might literally have to dip into their short-term working capital facilities just to find the cash to pay the unit holders their expected distribution. That is sustainable for maybe a quarter or two, but it's absolutely not sustainable forever.
Makes sense. And finally, let's touch on the geopolitical angle. I noticed the RHP excerpts explicitly mention it as a risk factor.
The China factor. The global solar module spares and critical technology supply chains are still heavily dependent on Chinese manufacturing. If there is an unexpected trade war or a new embargo, or if the Indian government decides to suddenly slap a 40% basic customs duty, a BCD, on all imported solar components, which they have historically done to protect domestic manufacturing, the baseline cost of basic maintenance and replacement spares spikes overnight.
So owning a seemingly isolated piece of the sun in the middle of Rajasthan is still very much affected by macro politics in Beijing and New Delhi.
We live in a deeply connected, globalized world. There is no true isolation in infrastructure.
Let's pivot to something that might actually help us sleep a little better at night after all those risks. ESG, environmental, social, and governance. Now, I have to be honest, usually I just gloss right over this section in annual reports because it feels like it's full of corporate buzzwords and stock photos of happy children planting trees. But for an InvIT, I feel like this actually directly impacts the P&L.
It absolutely does impact the bottom line.
Yeah.
And the G in ESG governance is by far the most critical metric for any infrastructure investor.
Why is the G so much more important than the E or the S?
Because in a trust structure like an InvIT, the external investment managers completely control the daily cash flows. If the foundational governance is weak, they can easily siphon money out of the trust through exorbitant management fees or excessive investment advisory fees.
Right.
Or worse, they can buy terrible low-yield assets from their own parent sponsors at artificially inflated prices just to bail out the parent company.
Ah, the classic related party transaction scam.
Exactly. It happens all the time in emerging markets.
Mm-hmm.
But here with SEIT, the documented stats are actually quite comforting. The board of directors has exactly 50% independent directors.
So half the people in the boardroom making the final decisions do not work for Mahindra or OTPP.
Correct. They have no financial loyalty to the sponsors. They are placed there specifically to represent You, the minority retail unit holder, they are the ones who hold the voting power to say no if the sponsors try to dump a toxic asset into the trust's portfolio.
That is reassuring. And what about the environmental side? You mentioned something earlier about being water positive.
This is a perfect example of where ESG directly meets the financial spreadsheet. In a massive solar park in the deserts of Rajasthan, clean water is practically liquid gold. Yeah. Traditionally, you clean solar panels by manually spraying thousands upon thousands of liters of pure water on them to remove the dust so they generate power efficiently.
Which obviously costs a lot of money to constantly trek into the desert.
A tremendous amount of money. And water inflation? The cost of acquiring that water in drought-prone desert regions is rising much faster than the baseline CPI inflation. SEIT realized this and has aggressively moved to robotic cleaning technology. Dry cleaning robots that brush the panels.
Wait, they use actual robots?
Yes, autonomous robots.
Yep.
And the Sustainability Source report explicitly says the singular change saved 216,336 kiloliters of water last year.
Okay. I mean, that is obviously fantastic for the local environment and the water table.
Forget the environment for just a second and look at it purely as an analyst. Look at the OPEX line item. Every single liter of water they do not have to purchase, transport, and spray is a direct one-to-one boost to the net operating income. By structurally eliminating their reliance on external water, they are effectively immunizing their entire balance sheet against future water scarcity pricing shocks. It acts as a massive defensive operational moat.
So in this specific case, being supposedly green is really just about being ruthlessly cheap and efficient. I really like that.
Operational efficiency is always profitable. Oh, and they also reported 0 workplace fatalities and hold ISO certifications like 9001, 14001, and 45001, and then 45000 Ocean 01. That isn't just paper pushing. It proves to institutional investors that rigorous standardized safety and management systems are actively functioning on the ground.
All right, so let's try to land this plane. We have covered a lot of ground today. We covered the pass-through structure, the sponsors, the actual asset quality, the financial math, the embedded growth levers, the critical risks, and the governance. If you had to summarize the ultimate investment thesis for SEIT, how would you box it up for the listener?
SEIT fundamentally is a yield plus moderate growth play. The base yield is solid, hovering around 9 to 10%, depending entirely on your specific entry price. The growth is modest, but it is contractually real, around 3% organic with upside from acquisitions. And the pedigree managing it is top tier with Mahindra and OTPP.
And who is the ideal buyer for this?
It is purpose-built for the income architect, someone who desperately wants steady, relatively inflation-protected cash flow and is mature enough to accept that their entry price dictates their entire return. Buying aggressively at 108 rupees is essentially a no-brainer for an income portfolio. Buying today at 125 rupees implies you are heavily bullish on interest rates dropping and you're willing to accept a sub-9% return if you are wrong.
That perfectly summarizes the math. But wait, before we wrap up this deep dive, I want to throw one final, slightly provocative thought at you. Something I noticed that absolutely isn't priced into any of these spreadsheets.
All right, I am listening. Go ahead.
We talked extensively about the DCF model ending in the year FY45. The power contracts expire, the glass panels are basically scrap, the expensive inverters are dead. The strict financial model says terminal value equals 0, or basically just the salvage value of the scrap metal.
Correct. That is standard conservative accounting practice for finite life assets.
But the land remains. These solar parks occupy massive acreage. We are talking hundreds and hundreds of acres of contiguous land.
Yes, they have a massive physical footprint.
In the year 2045, India is going to be a radically different place. The scarcity of clean, clear industrial land is going to be incredibly acute. What exactly is the intrinsic value of hundreds of acres of perfectly flat, secured land that is already fully connected to the national high-voltage transmission grids sitting in Rajasthan?
That right there is the hidden jackpot of the entire thesis. You absolutely cannot put it into a rigid DCF model because it is entirely speculative today. But just think about the underlying mechanics of it. The existing physical grid connection alone is worth an absolute fortune. Obtaining the right-of-way for new high-voltage transmission lines is already the single hardest, most politically fraught part of building infrastructure in India. SEIT already has that lockdown.
Exactly. So in 2045, maybe they don't even bother replanting it with new solar panels. Maybe the highest and best use is turning that grid-connected land into a massive AI data center park. Or maybe they sell it to a logistics company for automated warehousing.
Exactly. The strict terminal value in the Excel sheet says 0 to be safe. But the actual real-world value of 1,000 acres of prime grid-connected industrial land in a booming economy could mathematically be higher than the entire capital cost of the solar project today.
It is essentially a massive, long-term real estate land bank play disguised entirely as a boring power plant. That is the massive optionality upside that literally no analyst report is pricing in right now.
And that, my friend, is exactly why we always look beyond the glossy marketing brochure. You always have to look at the underlying land.
That is a perfect place to end. Thank you so much for joining us on this exhaustive forensic audit of buying the sun. We really hope you listening feel a little more equipped and perhaps a healthy amount more skeptical about buying your own slice of the energy grid. Until next time, keep analyzing the numbers.
And always keep your calculator handy.
See you on the next deep dive.